You know the story. Sometimes it's not just the news, it's about how the market responds to the news that is fascinating. What did you make of the sector price action in yesterday's sell-off?
Good morning, Jonathan. Thank you for having me on your show at such an interesting time. We think that the falls that we saw yesterday are likely to continue in the days ahead, but lay the groundwork for quite a decent rally into year-end, and 2021 should be a much better year. Sector-wise, we do think that there'll be a gradual shift in interest towards COVID cyclicals, as we call them. So areas like industrials, energy, financials, consumer staples, and more towards growth, towards value from growth in the months ahead.
Jeff, what's going to be the tailwind that drives that change? Because right now, Europe is looking really, really difficult.
Well, firstly, we do think we'll get through wave 2. We had been expecting it, and we do think that by year-end, we should be through the worst of the second wave. Policy support will be ongoing and critically important, both from governments and central banks. We've already seen signs that the governments are willing to do more and extend their furlough schemes. For example, European governments so far have spent €1 trillion, 8.9% of GDP, in addressing the pandemic, but they'll do more. So that's a second factor. Thirdly, valuations for European equities look really attractive on 15 times, supported by average dividend yields of 3%. And relative to fixed income, the yield ratio is really attractive at 2.5%. And finally, when you look at the technical backdrop for European equities, it's very attractive because the markets are under-owned and unloved. So we think that next year there'll be a gradual perception change towards European equities.
Jeffrey, good morning. With that kind of analysis, would you say you're a buyer on this dip?
We'd be a buyer into weakness, but in tranches. So we wouldn't be buying full position sizes now. We've got several weeks of COVID intensity ahead of us. We've also got the US election over the next few days that will cause further market uncertainty. So what we're looking to do is build position sizes that we want to have for next year by the end of this year. So tranches for us are particularly important to get those good average prices.
And what about earnings? Does the coronavirus really just put a dark shadow over the earnings we've seen, which for some companies hasn't been too bad?
Well, it's been a really good earnings season for Europe, not just in terms of the numbers, there have been more beats than misses, but also in terms of the outlooks. The chief executives are mainly able to look further ahead than they were in the last set of results. That's important. But we also think there's likely to be more upgrades than downgrades in the months ahead. So we're expecting at least 30% EPS growth over 2021. And that'll, we think, be supported by GDP growth next year of around 4%. We're not expecting to need to downgrade that growth forecast because of wave 2. Our growth forecast was already reasonably conservative. An important assumption we're making is that the EU Recovery Fund, 750 billion euros, will be ratified by year-end. And we think that the second wave of the virus will probably intensify the discussions to ensure that compromises are made to get the ratification from the EU 27 governments.